Get ready for the price of everything to go up. QE3 is here, and it's not going away anytime soon. Ben Bernanke and his buddies at the Fed announced today they're going to be starting up the printing press and throwing away the key. The new QE3 is an unlimited and open-ended program that will begin buying, you ready for this, $40 billion of mortgage-backed securities a month to lower mortgage interest rates in an attempt to prop up the housing market and create jobs. In other words, the Fed could print and buy as much as it wants, and it doesn't have an end date in sight. The reason why there's no end in sight is because Bernanke is trying to use his easing to drop the unemployment rate. According to its own numbers, the Fed predicts unemployment to remain above 6% until 2015. What Bernanke is really saying is we can have 3 more years of this. You know, it was the same type of academic, like Christina Romer, you know, the author of the failed stimulus package, that said unemployment would not go above 8%. Bernanke and the academics aren't examining the X factors of the real marketplace. Instead, they're nose deep in their textbooks. But why stop there? The Fed pushed back its target date to keep interest rates near zero until the middle of 2015. Banks already have $1.5 trillion in cash. They don't need any more money. Here's what another round of quantitative easing means for you. More of exactly what we've already seen. Higher commodity prices and a weaker dollar. When the government prints more money, it cheapens the currency. It's like taking something of value, watering it down, then trying to put it back into the market and expecting it to have the same value and potency. It's not how the real market works. It's why you see prices go up for everything. I'll lay it out plain and simple. Quantitative easing and currency manipulation doesn't work, and it never has. Let me get to my panel. Matt McCall is the president of Penn Financial Group, and Ed Butowsky is the founder of Chapwood Investments. Guys, I don't mean to make you angry here, but before I get you all fired up, I want you to hear Ben Bernanke in his own words from today. Let's play that.
Inflation has varied in recent years, with swings in global food and fuel prices caused by a range of factors, such as drought and geopolitical tensions. However, overall inflation has averaged very close to the committee's goal of 2% per year for quite a few years now, and a variety of measures show that longer-term inflation expectations are quite stable.
Unlimited easing tied to unemployment. Has currency manipulation ever created jobs?
Long-term sustainable jobs? Absolutely not. A job that maybe to go build a road for 6 months? Sure, you could throw some money, stimulus money out there and create some jobs for a few months. But that's the issue with this administration right now and with the Fed. They're so short-minded. They're not looking at the long term. This is a major wound that we're dealing with right now in the United States, and they're throwing on these little Band-Aids. But today when they came out, Andrew, and they said, basically, we can do this until we can't do it anymore. You know how hard it's going to be to stop this $40 billion of buying every single month? By the time we do end this, our dollar, that dollar that's in my pocket right now, is going to be worth nothing. And then what happens? The middle class, who Obama is for, gets hit the hardest with increasing prices for food, increasing prices for gas, increasing prices for metals. Anything they use will be going higher.
Now, and I want to ask you this. When the value of a product stays static, because producers don't just say, well, all of a sudden, I guess my stuff is worth less.
Right.
When the currency is worth less, the providers of commodities have to raise their price to make up for the currency loss. That's the higher prices he's talking about.
Well, without question. And something that we tend to just accept. We tend to accept the CPI, the Consumer Price Index, as a realistic measure of the cost of living. I actually got so annoyed with this, I started my own index to measure the cost of living increase. You know, we all talk about how much the cost of living is, and we just accept on face what Bernanke says. Oh, it's at our long-term or our target rate of 2%. That's a bunch of nonsense. Everybody knows their cost of living goes up somewhere around 7 to 8% at least a year. So to remain constant from last year to this year, you had to increase your salary or your portfolios about 8%. Now, to your point, when we start printing money, the value of the dollar goes down. So now you have a double play, a double negative play. And as Matt said absolutely perfectly, the middle class and single women are going to be targeted more because they use a disproportionate amount of their money for food, energy, and those types of things. This is exactly a tax on the middle class.
You know, the funny thing is when they print all this money, they never take it off the books. I'm no Keynesian, and I would never support it. But let's just get crazy for a second here. Let's pretend they printed $40 billion a month, or they bought $40 billion mortgage-backed securities per month. And they put it out there in the economy. They put it out to the banks start loaning it. It stimulates a little growth. And then when it came back in the form of tax revenue, whatever taxes were paid on that, they burned it. But they don't do that. They leave it on there so the currency is permanently devalued, making, if I'm wrong about this, when have prices for anything in our economy gone down?
Yeah.
Down. Cost of living just keeps going up.
But they keep manipulating the CPI number. And don't forget, we're in a world economy. What are they doing in Europe? The same exact thing. You had Geithner go over there and test, basically give them a lesson on how to handle this. Well, guess what that lesson? More printing of the euro, printing here in the United States. We are going to be so much inflation, prices are going to rise all around the world, as we know.
And the reason we haven't seen that U.S. dollar fall apart yet, it's the best of the worst. What are the currency out there? Currency market is enormous. Trillions of dollars traded in a currency market. Do you want to bet on the euro? No. Do you want to bet on the Chinese yuan that's manipulated? No. So people have to invest in the U.S. dollar. Eventually, they're going to say, you know what? We're not going to believe in the U.S. dollar anymore either. Then we're in a heap of trouble.
You know what's funny is that viewers to this program, this network, we all talk about gold. I mean, there's a lot of gold investors watching. Sure. Some of our progressive friends came out against gold and precious metals, saying, the spot price and this, that, and the other thing. If currency manipulation is working, why is gold and platinum through the roof? Because investors are getting out of things. They're going to be facing what amounts to a backdoor tax when the government devalues the currency.
Well, and not only that, and Matt has a great background in technical trading and so on, and a lot of these commodities trade that way. So they get limit up and then they just stop out, and then the next day they go higher and higher. You really have to look at that trading. But when you just simply look at gold and anything you can put your hands on, that's where money's going to go. The dumbest investment in the world right now are government bonds. Okay? I mean, tell me something. Let me ask you a question. Would you invest in something that had a 1 or 2% upside and a 30% probability for a 30 to 40% downside? Because that's where bonds are right now. They're so overvalued because of the rush of money into government bonds. You would never do that, but that's what people are doing. And all of a sudden, when China doesn't answer their phone, when it's time for us to say, hey, please buy some more of our bonds, we're done.